What's up, everybody? Welcome to another edition of Zach's Live Trader. Here with you, as always, I am the bearded boy wonder, Dave Bartosiak, and today, my friends, we've got Taco Tuesday. That's right, David, Taco Tuesday. No, well, it is. But today, we've got Morgan Stanley, ticker MS. That's what we're going to be talking about here today. As usual, our new format here, guys, I've got the chat window up while I'm talking to you live. Now, there is a little bit of a delay, so you might notice that if I say something in the video, it seems like it's a little bit delayed. That's because of that. But in the chat, I am rip-roaring and ready to rock. So you can go ahead and throw comments in there. Not too many questions. A few questions I could take, obviously, because this isn't like a live Q&A session. We're going to do that again on Thursday in the morning, Thursday 9 a.m. So we're going to get started here, as we've got a pretty busy week for Live Trader, given that it is the first official big week of earnings season here. So we're going to be hearing a lot of companies reporting, so it should be exciting stuff. So why don't we go ahead and get elbow deep here into today's task at hand, which is Morgan Stanley. As usual, let's go ahead and use the price consensus and EPS surprise chart to begin our analysis. The black line represents the price, which corresponds to the right y-axis. The multicolored lines here represent the evolution of our Zach's consensus estimates over time. The green arrows are earnings beats. The red arrows, earnings misses. Haven't been too many misses. The most recent one being kind of a pretty drastic miss in October of 2015. Before that, a small miss in January of 2015. And then you got to go all the way back to 2012 to see the last one. Last real miss. Let's see if we can go back further, and you'll see again. So Morgan Stanley does a pretty good job of beating earnings, okay? And recently it's been pretty solid. 1, 2, 3, 4, 5 beats in a row. Pretty interesting here, this run up from the lows of February. Looks like February, right? I just assume whenever you're looking at these charts, just assume that the low is February of 2016, because that's pretty much every stock's low. And from there, going higher, of course. And then you have the recent lows, the November lows, the election day, or pre-election day lows, rather. Most stocks you'll see kind of bottom out then, or at least that's when they really took off, is following election day. And another pattern that you'll notice a lot is kind of mid-December until now, stocks ticking maybe a little bit higher or being stuck in the same consolidation range. I forgot to open up my Internet Explorer here. I'll go ahead and do this quick. So we're going to use freestockcharts.com here. We are going to be partnering up with NinjaTrader here pretty soon, so I can show you guys that, how we can use that in our analysis too. They've got some pretty nice additional add-ons that we can use. But hey, we're not looking at Golden Ocean, so what am I doing here? MS, ticker Morgan Stanley. Like I said, though, so this sort of mid-December through now, this is a pattern you're going to see a lot of. So even if you look at the S&P 500, right, mid-December kind of consolidation, move a little bit, and now we're coming lower. If you look at the Russell consolidation, this one's chopping around a lot more. NASDAQ's going to look a little bit different, but still pretty much consolidation a little bit later on. Everybody's had their consolidation, right? Or is in their consolidation. And Morgan Stanley should come as no surprise. Similar sort of scenario. But what's a little bit surprising about Morgan Stanley is how it kind of ran out of gas here early February. Anybody want to take a guess at what else kind of stalled out in early February? Now we're talking Morgan Stanley, so I want you to think banks. I'll give you a hint. The 10-year. So here we are, early March. And then all of a sudden, 10-year yields start dropping considerably. So this is a risk-off move. But this is something I'm going to tell you is that banks don't like this. When we were talking about JP Morgan and doing our analysis there, one of the reasons why I was bearish on JP Morgan was because of the 10-year. And you'll see how this has tracked down since early March. Coincidence? I don't think so. Yeah, let's look at Goldman. Same scenario, right? So all of these banks got inflated on the prospect of Trump coming in, the economy taking off, and the Fed having to be more aggressive with their rate hikes. The other thing was Trump had been, during his campaign and even in his sort of early days or after being elected, prior to getting sworn in, he'd been critical of the Fed. Kind of said they were bad for savers and that rates should have gone up and hiked up a lot quicker, right? So you had this sort of huge run-up in the banks in anticipation of that, and then the market doesn't care what you think. And now the 10 years going in the opposite direction of where we really think it should be. If you're in a rate tightening cycle, you guys would think that these rates would be going in the opposite direction, but they're not. This is risk off. This is what risk off looks like. I do this in my Dave's Daily Dive a lot, but look at, there's gold now, $12.90. Wow. Back to Morgan Stanley, the task at hand. Where is the possible support level here for Morgan Stanley? There are a few things to look at. The retracement from the pre-election day low to the recent high, draw your fibs, and look at this 50% retracement is almost spot on this $40 level. And that was the intraday low on March 27th, the $40 holler. This is interesting to see. What's also interesting to see, my friends, on my little handy-dandy Zacks software that I have here, our Zacks research system, that the price impact over the last several quarters for JP Morgan has been virtually nothing, right? Now, when I say price impact, what I mean by this is 2 days prior to earnings and 2 days after earnings. So a very short period of time, just what's the immediate impact on earnings from earnings. So, and if you go back further, you have to go all the way. I don't know. I feel like I skipped over it way too quickly there, but we go back one page, nothing here. Tick back again. You have to go back all the way to December 2012 to see that, right? A move that was of any substance, okay? So December 2012 was the last time anything happened of significance as a direct result of JP Morgan earnings. Now, that doesn't mean that there hasn't been some post-earnings drift. And we can see that here, is that there was definitely a move here, but they're not immediately, it's not 2 days after, right? Here again, a beat, kind of goes sideways, and then it moves. A beat, retreats a little bit, then it moves. So this is going to be one of those things that you probably aren't going to get a huge move following the earnings report immediately, but it will happen a little bit after that report, okay? So that's something to take a look at here. All right, keep that in mind when you're pricing it together, putting this together. So they're going to report before the market opens tomorrow, right? So we don't have a lot of time here. I'm kind of jamming these up here this week, doing it the day of, but doing it a little earlier. I know I want to try to get them out a day before the day of, give you 2 days at least. I really wanted to cover all these, and this was the only way I could do this week, okay? So let's look at the revenues here. Well, first of all, Zacks rank number 3 hold, top 22% of our Zacks industry rank right now. And let's look at the sales estimates. Pretty surprising. This will, at least to me, it was surprising to see 16% year over year revenue growth in Morgan Stanley. And if you look at next quarter, it drops down to 3% growth. Current year number is 4.8. Next year number 3%. So are they modest? Yeah, I think they're being modest here. But if you look at the EPS growth, huge growth year over year for the current quarter. Next quarter looks like 14.3%. Current year 15.26. Next year 12.19. And if we're looking at the individual analysts that have come out, you got one analyst over the course of last week that has come out and increased their earnings estimate for the current quarter. Pretty bullish over next quarter. Two analysts increasing. If you look at the current year number, a little bit of bullish tilt also next year number. So there is a bullish tilt. Overall effect on our Zacks consensus estimate was we basically went from 88 cents to 90 cents for the current quarter, 85 cents to 86 cents for next quarter, and 338 to 345 to 337 for the current year. Next year number 392 to 378. So a little bit of negativity, I suppose, which is surprising given that people have actually been increasing their estimates. Maybe they troughed, they did, and then got a little bit more excited. But I don't know. This is an interesting thing for me to see. I just didn't think we'd see that. And when you're looking here at this detailed estimates, we're looking at these, the price consensus EPS surprise. You do see the trough here, and you see the growth. But when you're looking at these estimates, it doesn't look like they've given up, right? It doesn't look like they ticked down with a big trough and came up. So I think earlier in the year, maybe you had much more negativity, which was what pulled the stock down. But really what you have to ask yourself with shares of Morgan Stanley is this already priced in too much, right? Did they price in too much of a move already? Looking forward towards next year, looking forward towards having lower rates. Now, one thing that J.P. Morgan said during their report is that their their trading division did very well. So that's certainly something that we could see happen last week, right? Or that we can see happen here with Morgan Stanley, is if their trading division is doing better on the fixed income side, then maybe you'll see a big shot in the arm here. But how sustainable is that over the course of the next year, and what is all this going to look like, right? So there you go. So that's what we got to start looking at when we're talking about Morgan Stanley, rather. Okay? And look at the surprise history. There have been some good surprises, so they're probably going to beat, right? Because they're doing a good job managing expectations, and they're going to come in and they're going to beat, right? They're going to beat, but low likelihood of a lot of movement on the stock immediately following. All right? Okay, armed with this knowledge, let's take a look at the options chain. So first, to do our implied volatility calculation, we got a $40 holler on this stock. Let's go ahead and look at the 40s. At the money call, at the money put. Actually, how much over 40 is it? Because now I see there's 40-50s here. 40.85, so we actually do have to look at the 40.50s. So we'll look at the 40.50s. Bust out your handy dandy calculator. And the 40.50 call, 118. The 40.50 put's going to cost you 35 cents. That's $1.53 on 40.50. So you're talking 3.7% they're looking for in earnings. Goldman Sachs didn't have too good trading results, huh? No. When Goldman doesn't have trading results, you kind of wonder, right? Because they're the ones who are supposed to be running everything. So it makes you wonder. So 3.7%, or basically $1.50 is what we're looking at here. This makes it easy. So 39 and 42. So this is sort of the realm that you want to be playing in when you're talking about shares of Morgan Stanley. Okay, so we know that they're not going to move too much on this earnings report. Or in the past, they haven't moved so much on these earnings reports, right? And I know that people have been wanting me to put together a calendar spread for the longest. And I'm not officially going to do that here, okay? But I will kind of throw out an idea for that. So don't let me leave without talking a little bit about a calendar spread, okay? So what I mean by that calendar spread is you would sell something that was at the money, or you would sell the front month contract, rather, I guess is a better way of saying it. You'd sell the front month, and then you'd buy the next month over, right? So that way, what you're going to do is you're going to take in the premium from the front month, the expectation that people have that it's going to move, and then that will help offset how much money you're doling out in the long run for that other, for the further out month, right? But here's the thing. When we're constructing these, oftentimes we're in that, when we go further out, we're putting together a call spread or a put spread anyway. So we're selling in that month. So we're getting a bunch of that time value and implied volatility back anyway. So while it is, it's a decent strategy, it does limit your upside. And I think we talked about it with Netflix even, how one strategy essentially you lost, you could make 25% was the most that you could make, and then it mitigated your loss significantly, which was good. Anywho, so let's go ahead and go a little further out because we want to give it some time to get that post-earnings drift. Let's look at May, the May 19th expiration, and put together a couple of things. So it's all about that drift, right? So it doesn't move a lot initially, but what happens after? So here's a stock. It went from 33 in October to 35 in November, okay? Another move here, it goes from 37 in April to 38 in May, so not much of a move there. Here's a significant move from 39 in July to 34 in August, and then it just got even weirder. Lots of chop there. This was a crash before a big beat, chopping around. What's this move? 28 in July to 30 in August, so just a couple of bucks. And then here's probably the largest move, October to November, going from 32 to 38, right? Pretty big move there, but for the most part, you don't get that. It's only a buck or two, a couple of bucks, right? Now, a couple of things when I'm looking at this options chain is sticking out at me is we've got some fat here, and here. Actually, this is probably a better way to show this instead of, there we go. There. So 46s, 44s, 43s. So where a lot of the open interest is. It's not here. So let's look at a call spread first. Long 40s. We said $1.50 to the upside, basically. So let's call it 42. That's where it was running to, right? Which is just under this huge area of open interest. What is this price out at? Long the 40s is 194. Short the 42s is 92. So it's going to cost 102. But here's the thing. This is a stock now that's almost at, as I was talking about it, we're almost at 41 now, right? So maybe I am comfortable going just 10 cents out of the money and looking at the 41 as the long leg. And then maybe it does get to 43. Because that's where a lot of this open interest is. So maybe that does attract some action. So let's just price this one out. So 143. You go long the 41 call. This is, again, May 19th expiration. 143 is what it would cost me to buy that 41 call. Simultaneously short or sell to open the $43 call. get back 58 cents. So that's 85 cents net debit. 115 is the upside potential because that's the difference in the strike prices minus the net debit of 85 cents. So you got the potential for 135% rate of return here. You need to see shares of Morgan Stanley rise up above $43 at expiration. Okay, so bullish trade long the May 19th rather. I kept doing that last time because April's the 21st. May is going to be the 19th. May 19th, $43 call spread, 85 cent net debit, right? Okay, so that's bullish. On the bearish side, you'd expect it to unwind a little bit. And again, just a quick little eyeball check here. You got a lot of open interest here at 40, and then a real decent chunk at those 38s. So we can use 41 as the level that we go long. And if it gets under 40, let's look at I want to go quick back here. Back to my chart. Remember that $40? That's why there's so much open interest there. Is look at that is also providing support on a technical level too. So that's a twofer there. A lot of support. And look at it chopping in this channel here for an extended period of time. Creeps up. Let's go. Interesting. What's the bottom of this? 38. This 61.8% retracement is basically 38.5. Back to our levels. I don't have a 38.5, but I got a 38. So maybe 39s. So we've got to be a little bit more conservative, I think. Let's do the 41.39 and see what this looks like. Again, I am a little nervous that you've got so much open interest at 40, and it's also that support level. But what's going to break the support level? It's going to be an earnings report. Long the 41 call for $1.56, simultaneously shorting or sell to open the 39. These are puts, rather. Sell the 39 put. So long the 41 put, short the 39 put. You're going to get 84 cents. So this is almost exactly the same trade, same risk parameters. You can make 116 on 84 cents. So this is the bearish side. Bearish trade long May 19th. 41.39 put spread for a 84 cent net debit. Okay, couple ways to play it there. That's if you want to catch some post earnings drift. Now there's one other trade I want to look at, and that is what do you guys think this one's going to be? I want to price on Iron Condor on this. Just to see. Now, $40. Let's assume that $40 level can hold. Let's frame this up a little bit better also so we can see. So I was saying 39s and okay, good. So right now we've got a stock that's right at $41, right? So what if this $40 level can hold? And where's the upside? 42. There's a decent amount there. Yeah, let's say that. Let's do that. And then we'll say that 42 kind of holds it. So we're basically saying the stock doesn't go anywhere. Okay? What if the stock goes nowhere? And I'm going to do 42.43. And then over here, we're going to price the 40.39. Okay? So an Iron Condor. So in this case, this would be an Iron Condor that's a buck out on either side, which isn't a lot, right? I understand it's not a far out Iron Condor at all. I just want to price this out a little bit at the $40 level. So these are both going to be credit spreads. So this is short the 42, long the 43 call, short the 40, long the 39 put. So 2 credit spreads. And what you're essentially saying is you want this to stay between 40 and 42. So 25 cents is essentially what you're going to get for selling the $42 call. And it's going to cost you 8 cents to buy the $43 call. So that's 17 cents in your pocket. Okay. And then on the flip side, 29 by 31 or 32. So let's say you could sell the $40 put for 30 cents. And then you can buy the $39 put for 13 cents. So that's also 17. So you're going to get 34 cents is the amount of money you can put in your pocket on this one. And the total amount of money you're going to have at risk is the difference in the strike prices here minus what you put in your pocket. So it's essentially $1. So 66 cents is what you're going to have at risk. So you can make 51% on this, and all you need to have happen is Morgan Stanley shares have to stay between 40 and 42 at expiration just a couple of days after earnings. Okay? Now that may seem too tight of a condor. So you can just scooch her down a little bit. And you'll see that this isn't going to have a dramatic effect, or as dramatic effect, I think, as you'll believe on the actual return you can get. So let's see if you just pushed them out by 50 cents on either side. So now, first on this call side, we're going to sell the 42.50. So it's trading 14 by 17. So let's say you can get 15 cents for it. Then you got to buy the 43. It's going to cost you 8. So that's 7 cents you're going to get on that side. On the other side, 18 by 22. I should be able to get 20 cents for this one. And then this is going to cost me 13 to buy the $39 put. So again, 7 cents. 7 cents on each side, 14 cents overall. Okay? Now, the difference in the strike prices here is only 50 cents. So the amount of money you're going to have at risk is 50 cents minus the 14 cents that you took in, or 36 cents. So in this case, you can make 14 on 36 or 38% rate of return. And what you need now is Morgan Stanley shares to stay between 42.50 and 39.50, okay, for a 38% rate of return in 2-3 days, okay? So I'm going to say the less aggressive condor is the April 21st, 42.50, 43, 39.50, 39 for 14 cent net credit. Okay? And the reason why I'm looking condor here is because we've seen in the numbers historically that JP Morgan has a tendency to not move so much as a direct result of their earnings report. I mean, I keep saying JP Morgan. Morgan Stanley doesn't move so much following its earnings report. So this is a way that you could take advantage of that. And I do think this extra 50 cents is going to make a difference. The other reason why I think it's going to make a difference is you got huge open interest on that side. And you've got a really good chunk of open interest there. Okay. Now, granted, there's more here at the 43s, but that just seems, there's also more at the 45s, and I don't think it's going to go to 45, right? So I see that. It tells me a little something. So I wouldn't be surprised if this 42.50, 39.50 condor thing we're looking at works out, okay? But again, if you do want to be bullish or bearish, and I know you guys are going to make me pick a side, bullish or bearish, right, overall. I mean, I do like the condor for this, but I think that I think that shares have kind of priced in a big move already in interest rates, and if interest rates continue to tick down, then you're going to see Morgan Stanley shares continue to tick down. So I got to lean on the bearish side here also for Morgan Stanley. But I think that so you can basically do two trades if you wanted to. You could put on the iron condor, and you could pick a bullish or bearish side, and at least that's one way to sort of mitigate your risk, right? Because if you end up putting on, well, the bad part is you could be wrong twice, right? Because it could totally move in one direction, big time right off of earnings, and be right in your face, and you're going to lose. But hey, this is the game that we play, my friends. We know what's going on. We know what the risk is, okay? So going back to the chart, that's basically me saying 39.50 and 42.50, right? So those are kind of the parameters I'm looking at. I think it stays between, and then I think it starts to kind of chop on down, to be honest with you, over the course of the next several weeks. I think it retraces a little bit more, and catches a little bit of this. Dips down below a little bit. I don't know. There's support there right now, but I think it can dip down below 40. Okay? All right, everybody. So thanks so much for hanging out with me here today on Zach's Live Trader. Don't forget that tomorrow I'm going to be doing, Qualcomm, just for the premium folks. And then Thursday, we're going to do Skechers, but we're also going to do that live Q&A. And the Q&A session is also going to include the good, the bad, and the ugly. I'm trying something new. I'm going to try to put it all together because I think it'll add value versus me just, sitting there talking to a PowerPoint presentation about, making moves. I think maybe that can help out a little bit better. I think that I add more value, okay? So that's what I've got for you guys today. That's all I got. That's what I got for the rest of the week. Skechers Thursday, Rambus Friday, and Qualcomm tomorrow. So thank you guys so much for hanging out with me today here on Zach's Live Trader. And I will talk to you all tomorrow. Have a good one.